In the last episode, we looked at how a price increase can impact volume, profit, customers, and market share. In this episode, let's answer another important business question. Why did sales increase but profit fall? Imagine you're presenting the quarterly business review. You start by saying, sales grew by 12% this quarter. Sounds like great news. But then the CFO asks, if sales grew by 12%, why did profit fall by 5%? And suddenly, the conversation changes. So let's investigate. First, let's ask the obvious question. Did revenue actually grow? Sales increased from 100 to 112. That's a 12% increase. So yes, revenue clearly grew. But revenue growth alone doesn't tell us whether the business created more value. And that's where we need to look deeper. Our first question is, did customers actually buy more? Suppose volume increased from 100 to 103. That's only a 3% increase in volume. The remaining sales growth came largely from higher prices. So sales increased by 12%, but customer demand increased by only 3%. That's an important distinction. Now let's ask another question. How much of that growth did we actually keep? In many businesses, especially FMCG, the price customers see isn't necessarily the amount the company realizes. Trade discounts, promotions, and other commercial investments can reduce the realized revenue. So we need to look beyond the headline price and understand the net revenue after discounts and promotions. Now let's look at the cost side. Did costs grow faster than sales? Our cost of goods increased from 70 to 82.5. That's an increase of almost 18%. Remember, sales increased by only 12%. So our costs grew significantly faster than our revenue. And that puts pressure on profit. But there's another question analysts should always ask. Did our product mix change? Imagine we have two products. Our high margin product declined by 5%, while our low margin product grew by 25%. Overall sales still increased, but we are selling more of the products that generate less profit. This is why sales mix matters. The business can grow while the quality of that growth gets weaker. Now let's look at operating expenses. Suppose operating expenses increased from 10 to 10.5. That may look small, but when combined with higher product costs and an unfavorable product mix, it further reduces profitability. Now let's bring everything together. Sales increased from 100 to 112. That's 12% growth. But our cost of goods increased from 70 to 82.5. Operating expenses increased from 10 to 10.5. And profit declined from 20 to 19. That's a 5% decline in profit. So now we can see the full story. The business didn't have a sales problem. It had a profitable growth problem. Sales grew, but costs grew faster. Volume grew only modestly. The product mix became less favorable and operating expenses increased. So when management says sales are up 12%, the analyst shouldn't stop there. The next questions should be, where did the growth come from? Did volume actually increase? What happened to discounts? Did costs grow faster than sales? Did product mix improve or deteriorate? And most importantly, did the growth create more profit? Because revenue growth is not the destination. Profitable growth is.